it's a messy situation, but to me, what it translates. You asked before the show, kind of what does it mean for people who are retiring and seniors and people more in my age cohort. I'm 67. You've got to have monetary debasement insurance in an environment like this. Now, owning one Bitcoin is within the realm of possibility for a lot of people, not everybody, but a lot of people. But when Bitcoin goes up 10x from here, it's going to be damn hard to own one Bitcoin. If you're just a regular person. I mean, and Bitcoin is going to go up 10x from here, in my view. You've got to have a long-term perspective on it. And I always say the wrong allocation is zero. Even only 1 or 2% of your net worth in it, it's going to make a difference. And if you know about it, you don't put 1 or 2% in, what are you thinking?
Lepard opens his discourse by highlighting two critical indicators of monetary instability: gold and Bitcoin. Both assets, traditionally seen as hedges against currency debasement and inflation, are at record highs. Their performance, Lepard explains, is a direct response to years of excessive money printing and fiscal mismanagement. For individuals, particularly retirees and seniors, Lepard emphasizes the importance of holding monetary debasement insurance. Bitcoin, in his view, represents the most effective hedge against the erosion of purchasing power. Owning even a single Bitcoin, Lepard argues, is becoming increasingly challenging for the average person as its value continues to rise. He predicts a tenfold increase in Bitcoin's price over the coming years, though the timeline remains uncertain. This growth trajectory makes early adoption crucial for those looking to protect their wealth.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The two fire alarms for money printing and monetary debasement and future inflation are gold and Bitcoin. And gold and Bitcoin are both at record highs, right? And so the market is telling you, hey, and by the way, bonds haven't done particularly well. And in bond terms, last 3 years, gold's up 180% relative to bonds, and Bitcoin's up 3,000% relative to bonds. And so, the long bond used to be the base of the entire financial system, and it's kind of burning or leaking or falling down, however you want to describe it. And that's a real problem, because what it means is if interest rates go up and people aren't buying the bonds, okay, as Alan Greenspan and others have said, the U.S. can never default because we've got a tool. Bernanke said it, we've got a tool called the printing press. So, they will print to buy those bonds. It's called yield curve control. They will put them on their balance sheet and they'll mouse click the money into existence. But, the world knows what that means. That means there are more monetary units chasing the same goods and services. And so guess what happens? The price of the goods and services go up. And so it's a cycle that's very damaging, and the only way to try and get it under control is to raise rates again. But if you do that, you're going to have a big recession, and it's a messy situation. But to me, what it translates. You asked before the show, kind of what does it mean for people who are retiring and seniors and people more in my age cohort. I'm 67. You've got to have monetary debasement insurance in an environment like this. Now, owning one Bitcoin is within the realm of possibility for a lot of people, not everybody, but a lot of people. But, when Bitcoin goes up 10x from here, it's going to be damn hard to own one Bitcoin, if you're just a regular person. I mean, and Bitcoin is going to go up 10x from here, in my view. Now, we can debate over what time frame. I mean, there's a lot of debate about that, and I can see both sides of both arguments, but it's going up. And yeah, I agree with you. I mean, I don't know. I'm of two minds on this, as I am on so many things. I mean, the one is, let's just collapse the whole damn thing and get it over with, rip the Band-Aid off, return to sound money, and the world will be a better place. However, if we go in that route, there are going to be a lot of people hurt who don't, get on board along the way and adjust, give them time to adjust. The alternative is we go slower and more people get time to adjust, and less people get hurt because a lot of people have taken the steps necessary to protect themselves. And so there's an argument for that as well. I mean, I think, you're younger, so you could probably live with either event. I'm older. I prefer it to go faster because I want to be here to see it.
Yeah.
but look, to me, it's going to unfold over the next 10 years. There's going to be a lot of change in monetary affairs. Things are happening really quickly now. I mean, things that I just never could imagine happen. I mean, the approval of the ETF was a huge deal. Larry Fink at BlackRock, the biggest asset manager in the world, embracing it. It's a huge deal. What Michael Saylor is doing with MicroStrategy, basically, hoovering up the entire bond market, that's a huge deal. I mean, it's, sovereigns probably buying it. We know El Salvador, but we know there are probably a few others too. That's a big deal. I mean, the Loomis bill to have a strategic Bitcoin reserve in the United States, that's a big deal. I mean, it's, it's gaining momentum. And, the thing I'm trying to do with the book, and the reason I'm pushing hard to get it out, it'll be out in the first quarter, hopefully in February. It's all gaining momentum. I want to get people to, focus on it, pay attention now, because, in a year from now, it's going to be harder to, it's going to be more expensive. You got to be willing to ride these roller coasters, and you got to understand what you own, why you own it. And, I don't need it to live. These are my long-term savings. I'll probably end up going to my kids. I know that in a 5, 10, 15-year window, it's going to continue to go higher. And as you and I both know, anyone who's ever held it for over 4 years is not underwater. I mean, these downdrafts tend to be less than 4 years in length, although they can be quite severe. They were severe. I think they're getting less severe over time. But it's important. I mean, I always counsel Bitcoiners trying to sell their friends on Bitcoin. You need to explain that whatever they put in, they have to be prepared to handle a 50% drawdown and not panic. Because, that could happen. And if it did happen, it would be a buying opportunity, not the time to sell. And, and one thing that is notable is that with each cycle, we hit higher highs and higher lows. And in my book, I actually draw this comparison. I mean, it's kind of like Amazon. Amazon took over the world of retailing, online retailing. And, Amazon has had like 10 or 12, 50+% drawdowns, and yet, it's one of the best performing stocks of the last 15, 20 years, if not the best performing stock. So, when you've got something that's new and emerging and challenging the system, you're going to have emotions, and the emotions are going to lead to, oh, this thing's great, it's going to 1 million, and you're going to get some dumb people who are going to FOMO into it, and then they're going to panic and sell it, and it's going to go down and lose some value. And those cycles are part of the process. And the way that, senior people or older people who are getting into this, the way you deal with that is you don't put 100% of your money in this thing. But, you put in 10% or 15% or 20%, a number where, even if you only have 10%, look, I think this thing's going to go up 10x, and I think it's going to go up 10x again. And that's probably over 20 years. Yep. That's 100x your money today. So, if you put 10% of your net worth into this thing today and it went up 10x, well, you would double your net worth. And if it went up another 10x, you would 20x, that would be great, right? I mean, you're like 2,000x your net worth. So the point is that you've got to have a long-term perspective on it. And I always say the wrong allocation is zero. Even only 1 or 2% of your net worth in it, it's going to make a difference. And if you know about it, and you don't put 1 or 2% in, what are you thinking? I mean, there's not a soul in the world that can't afford to lose 1 or 2, that has savings, that can't afford to lose 1 or 2% of their net worth. It's just, there isn't one, and yet, if they put 2% in and it goes up 10x and 10x again, that's going to be, one heck of a return. They're going to be glad they're there.
Yeah.
So, it's something that everyone needs exposure to, but I think you need to look at the risk dial. I mean, those of us who are in it heavily, we're very comfortable with the risk. And, I know 30-year-olds who have 100% in it. I don't have 100% in it, but I have over 50, I have a big number in it, and that's okay. I mean, partly it got there by growing. I didn't start off putting half in, but but it's become half, and I suspect it could become 70, 80, because I'm not selling. If it keeps going up in value and, my gold doesn't go up as fast, which has been the pattern, then, the 50% or 60% I own now is going to become 70 or 80 or 90.
Lepard advises a balanced approach to Bitcoin investment, emphasizing diversification and risk management. For those hesitant to commit large sums, he recommends allocating a small percentage of their net worth, potentially as little as 1 to 2%. Even modest exposure, Lepard argues, can yield substantial returns over time due to Bitcoin's potential for exponential growth. This strategy aligns with his belief that the wrong allocation is zero exposure, as the opportunity cost of ignoring Bitcoin could be significant.
The math of the problem is getting more severe. I mean, they're being forced with every intervention. This is I mean the monetary authorities, principally the Fed, but others as well, are being forced to print more and spend more. And as you'll see in the book I'm about to put out, we're kind of, it's accelerating, right? I mean, the GFC, we printed a certain amount over a longer period of time. COVID, we printed more quicker. And the U.S. federal debt doom loop, the federal budget in the United States is really in rough shape and getting worse. And in spite of, Elon and Vivek saying they can solve it, my evaluation of the math suggests they can't. They can make it better. And that's a good thing, but it's really bad. So how much better they can make it is unclear. But somewhat embedded in your question is how much time do we have before the system comes unwound? And I don't really know. It could be a week. It could be a couple of years. It could be probably all the way unwound. It's maybe 5 or 10 years. But I think we are going to have some kind of a financial crack up in the next year, say, year and a half. And when we do, I think that they'll come in with the fire hoses of liquidity, and that will fuel the next round of inflation. I mean, we had obviously very high inflation with all the COVID stimulus and the money printing. We grew the money supply 42%. And I think that, we're looking at another one of those, maybe, obviously not driven by a pandemic, probably not driven by a pandemic, but just driven by, whether it's a stock market collapse or a commercial real estate collapse or bank troubles or, there are a lot of possible triggers as you look around, but I think something will break, and the Fed, and probably the bond market is the most likely thing to break as this inflation starts to continue to creep back in, as it appears to already be doing. They're going to see that they really haven't got inflation under control, and the bond market's going to say, oh, we don't like that. So the U.S. government, who lives by selling bonds, is going to have a hard time selling their bonds, and if so, the rates are going to go higher. Higher rates are going to mean more interest expense. More interest expense means bigger deficit. Bigger deficit means you got to sell more bonds. I mean, you see where I'm going. It's a doom loop. So, I think that's kind of what's in our future.
Lepard's outlook on the global financial system is sobering. He identifies a doom loop of rising deficits, increasing interest expenses, and relentless bond issuance. This cycle, driven by unsustainable fiscal policies, is exacerbating the fragility of the financial system. He anticipates a financial crack-up within the next 1 to 2 years, potentially triggered by events like a stock market collapse, commercial real estate downturn, or banking crisis. When this occurs, Lepard predicts central banks will respond with massive liquidity injections, fueling another wave of inflation.
Please like and subscribe my channel.